Money Power Fraud presents Stanford International, Offshore Banking, and CD Fabrication. Chapter 1. The Illusion of Caribbean Certainty. The product was simple, a certificate of deposit issued by Stanford International Bank. Fixed term, above market yield, capital preservation, conservative asset allocation. Investors were told their money sat inside a carefully managed portfolio of liquid instruments, high-grade bonds, diversified equities, and conservative alternatives designed to smooth volatility while enhancing return. Performance was steady. Losses were rare. Volatility appeared muted. In financial markets, that combination does not exist without trade-offs. Yet Stanford's CDs consistently outperformed U.S. bank deposits while maintaining the visual stability of Treasury-like instruments. That was the first structural contradiction. A legitimate bank CD functions as a liability of a regulated depository institution. The bank takes deposits and allocates them across loans and securities, subject to capital ratios, liquidity requirements, stress testing, and regulatory oversight. Yield is constrained by market rates and regulatory capital structure. Stanford's offshore CDs operated outside that constraint architecture. They were marketed as safer than U.S. deposits, yet yielded more. That narrative was anchored in geography. Antigua was framed not as a risk variable, but as an advantage. Investors were told that international positioning allowed greater flexibility, more diversified global asset access, and less restrictive U.S. regulatory friction. Offshore became shorthand for sophisticated. The psychological framing was deliberate. Domestic banks were portrayed as conservative and bureaucratic. Stanford International was positioned as globally agile and privately optimized. The pitch was not speculative. It was disciplined. The branding reinforced the claim. Formal documentation, clean performance charts, institutional language. The aesthetic mirrored a private banking environment rather than a speculative investment shop. For high net worth individuals, particularly in Latin America and the southern United States, this mattered. The institution did not present as a hedge fund. It presented as a private bank. The yield differential was explained through diversification narratives. Investors were told the bank deployed capital across international markets, currencies, and structured products unavailable to ordinary U.S. depositors. That global reach was positioned as the source of enhanced return. In reality, enhanced return without volatility implies leverage, hidden risk concentration, fabricated reporting, or undisclosed capital recycling. The core appeal rested on three engineered assurances. First, stability. Account statements showed steady upward movement, no sharp drawdowns, no visible crisis exposure during turbulent periods. Second, exclusivity. These were not retail CDs advertised on television. They were presented through financial advisors and private banking channels. Scarcity reinforces perceived legitimacy. Third, authority. The bank operated under a charter in Antigua. It possessed physical offices. It employed staff. It sponsored international events. The infrastructure created visual legitimacy. This is how the illusion was built, not through dramatic promises, but through incremental credibility signals. The Caribbean setting amplified the narrative. Palm-lined headquarters and international prestige masked a critical absence: independent asset verification. Investors assumed that a bank issuing CDs must hold corresponding assets. That assumption was never independently validated at institutional scale. The CD structure itself enhanced the illusion of safety. Certificates of deposit imply fixed maturity and defined return. They are culturally associated with conservative banking. By using a familiar instrument wrapper, Stanford embedded risk inside a symbol of prudence. Instrument labeling shapes risk perception. If the same product had been labeled International Yield Fund, investor scrutiny would have intensified. By labeling it A, C, D, scrutiny decreased. The performance claims further reduced suspicion. Reported returns were attractive, but not absurd. They hovered in a range high enough to be compelling, yet low enough to avoid immediate disbelief. This calibration was precise. Excessively high returns trigger skepticism. Moderately superior returns trigger curiosity and eventual normalization. Over time, investors anchored to the reported consistency. Volatility elsewhere in global markets made Stanford's stability appear even more disciplined. During market turbulence, investors often assume that losses elsewhere validate gains in alternative strategies. Relative performance bias strengthened loyalty. The bank's communication style reinforced conservatism. Portfolio summaries referenced asset allocation models. Risk mitigation language was embedded in marketing materials. The tone mirrored institutional prudence rather than aggressive growth. Underneath that presentation, a critical structural question remained unanswered. Where were the assets held? In legitimate financial ecosystems, custodianship is separated from management. Independent custodians verify holdings. Third-party auditors confirm asset existence and valuation. Regulatory bodies demand consolidated reporting. Stanford International operated without transparent third-party custodial confirmation of the vast majority of reported assets. The illusion depended on internal control of information flow. Account statements were generated internally. Portfolio summaries were internally curated. Valuations were internally determined. Investors were dependent on the same entity for deposit acceptance, asset management, performance reporting, and redemption processing. That consolidation of functions eliminates friction. It also eliminates verification. The Caribbean narrative helped suppress this scrutiny. Offshore complexity creates psychological distance. Investors assume cross-border regulatory oversight exists, even if they cannot articulate its structure. Geographic distance becomes a due diligence deterrent. Few investors flew to Antigua to inspect balance sheets. Fewer still requested detailed custodial confirmation. The presence of a charter and physical headquarters substituted for asset transparency. The product's success was not built on explosive marketing. It was built on gradual trust accumulation. Financial advisors played a critical distribution role. Many believed in the product's legitimacy. Some were incentivized through commissions. When trusted advisors present a structured deposit product with clean performance history, skepticism declines further. Trust is transferable capital. The illusion of Caribbean certainty rested on a simple psychological chain. A bank issues CDs. Banks are regulated. CDS are conservative. Conservative products do not implode. Each step appears rational in isolation. Combined, they formed a cognitive shield. The broader macroeconomic context amplified the appeal. In the early 2000s, investors sought yield without equity volatility. After the dot-com collapse and later during credit stress, a steady return vehicle appeared disciplined rather than suspicious. Yield hunger increases fraud elasticity. When traditional instruments underperform, alternative vehicles gain narrative strength. Stanford's CDs filled that demand gap with a story of international diversification and prudent management. No dramatic spikes, no aggressive promises, just consistent outperformance. That consistency was the structural anomaly. Financial markets are volatile. Even conservative portfolios fluctuate. A product claiming superior return with muted variance demands independent verification. In the absence of that verification, the illusion becomes self-reinforcing. Reinvested interest compounds trust. Satisfied early investors become informal ambassadors. Social proof replaces forensic analysis. By the time structural questions arise, capital concentration is already deep. The opening chapter of the Stanford International case is not about collapse. It is about calibration. The yields were calibrated. The branding was calibrated. The geography was calibrated. The narrative was calibrated. The illusion of Caribbean certainty did not rely on spectacle. It relied on familiarity wrapped in offshore mystique. The first warning sign was not scandal. It was stability. In capital markets, engineered stability is often more dangerous than visible volatility. Chapter 2. CD Fabrication as Financial Architecture. The fraud was not built on exaggerated promises. It was built on product engineering. At the center of the system were certificates of deposit issued by Stanford International Bank. The CD wrapper was deliberate. It implied capital preservation, maturity structure, and disciplined asset backing. A legitimate bank CD is a liability instrument. The bank accepts a deposit, records it as a liability, and allocates capital into loans or securities within defined regulatory constraints. Capital ratios, liquidity requirements, and supervisory examinations create structural guardrails. Stanford's offshore CDs operated without those guardrails. The first architectural layer was capital aggregation. Investor funds flowed into Stanford International bank accounts in Antigua. The CDs were documented as fixed-term deposits. Investors received formal statements outlining principal, maturity, and promised yield. The instrument felt conventional, but the capital pool was not tied to a transparent asset base. There was no independently verified portfolio custodian confirming the existence of diversified bond and equity holdings at scale. The asset reporting was internally generated. That distinction is structural. In financial systems, separation of duties reduces fraud probability. Asset management, custody, and reporting are ideally independent functions. At Stanford, those functions were vertically integrated. That integration allowed fabrication. Phase 1. Capital aggregation. Funds entered through CD subscriptions marketed by advisors and private banking channels. Phase 2. Performance construction. Returns were not the output of transparent portfolio performance. They were engineered figures presented as portfolio results. The reported allocation mix, global equities, fixed income, private placements, created the appearance of diversification without third-party confirmation. Phase 3. Statement reinforcement. Account statements reflected steady appreciation. Performance reports referenced disciplined asset management strategies. Investors saw continuity. The absence of volatility was not a feature of market resilience. It was a feature of reporting control. A portfolio exposed to global markets inevitably reflects external shocks. Interest rate fluctuations, currency swings, equity drawdowns, these forces leave statistical fingerprints. Stanford's CD performance lacked those fingerprints. That statistical smoothness is a hallmark of fabricated or internally managed reporting. The architecture depended on information asymmetry. Investors saw summaries, not underlying custodial statements. They saw asset categories, not verifiable securities lists reconciled by independent administrators. The structure allowed the institution to describe exposure without proving it. When redemption requests occurred, they were satisfied, so long as incoming capital exceeded outgoing obligations. This is where CD fabrication becomes a liquidity mechanism. In a conventional Ponzi structure, new investor funds directly pay prior investor returns. Stanford's model added a banking veneer. The CD instrument made the structure appear deposit-driven rather than scheme-driven. Yet the economic mechanics were similar. Cash inflows from new CD purchasers provided liquidity to meet redemption requests and interest obligations. So long as confidence held and inflows remained stable, the system appeared solvent. The illusion required disciplined yield calibration. Returns were not marketed at extreme levels. They were slightly superior to comparable U.S. bank deposits. That marginal outperformance was the trap. It was believable. Excess yield creates suspicion. Moderate yield creates acceptance. By anchoring returns just above mainstream alternatives, Stanford positioned the product as optimized rather than speculative. The offshore setting reinforced this optimization narrative. Investors were told that regulatory flexibility in Antigua enabled access to broader asset classes and international arbitrage opportunities. The jurisdiction became an explanatory device for performance. What was missing was consolidated regulatory verification. Domestic banks are subject to stress tests and capital adequacy oversight. Offshore banks may be supervised, but cross-border transparency often weakens. U.S. regulators lacked consolidated supervisory control over Stanford International Bank's asset base. That gap became the fraud's insulation layer. Financial architecture determines detection speed. When reporting, custody, and oversight are consolidated under one entity operating offshore, detection latency increases. Advisors played a critical role in reinforcing the architecture. Many financial intermediaries distributed the CDs to clients under the belief that they were conservative deposit instruments. Commission structures incentivized continued placement. The product was positioned as suitable for retirees and capital preservation mandates. That distribution layer expanded capital inflow without increasing transparency. Another architectural feature was internal investment committee control. Portfolio allocation decisions were not independently validated through institutional-grade asset managers or third-party administrators. Decision authority remained concentrated. Centralization reduces friction, but also eliminates cross-verification. In legitimate global banks, internal audit, risk committees, and external examiners form overlapping defense layers. At Stanford, those layers were structurally weak or absent. Fabrication does not require dramatic falsification at every moment. It requires control over narrative endpoints. If an institution controls deposit intake, asset allocation disclosure, valuation reporting, and redemption timing, it controls the economic story presented to investors. The CD structure was not incidental. It was the ideal wrapper. Certificates of deposit carry cultural weight. They are associated with conservative savers, retirees, and capital stability. By embedding fabricated performance inside a conservative instrument label, the fraud inverted risk perception. The instrument signaled safety. The performance signaled competence. The geography signaled sophistication. Together, they formed a durable illusion. The structural vulnerability lay in liquidity math. If reported assets were real and diversified, they could be liquidated or transferred under stress. If they were fabricated or materially overstated, liquidity depended entirely on new capital. The system's sustainability therefore hinged on confidence and inflow continuity. During periods of market stress, investor behavior changes, redemption requests increase, inflows slow. A fabricated portfolio cannot absorb synchronized redemption pressure without exposing the absence of real assets. The architecture was stable only under positive confidence conditions. Once external scrutiny intensified and capital inflow slowed, the CD structure could no longer conceal the imbalance between reported assets and actual liquidity. CD fabrication was not merely false reporting. It was a deliberate financial architecture built to mimic regulated banking while operating without its verification infrastructure. The wrapper was conservative, the reporting was controlled, the oversight was fragmented. Under those conditions, fabrication could persist until liquidity demanded proof. Chapter 3. The Offshore Shield Strategy. Fraud durability increases with jurisdictional complexity. Stanford International Bank was not placed offshore by accident. Antigua was not merely a headquarters location. It was a structural defense layer. Offshore banking provides legitimate global financial services. It also creates regulatory fragmentation. That fragmentation slows enforcement velocity. Stanford's strategy relied on this delay. The bank operated under Antiguan regulatory authority. U.S.-based affiliates marketed and distributed the CDs, but the deposit-taking entity resided outside direct U.S. banking supervision. This created a jurisdictional handoff problem. When questions arose, responsibility diffused. U.S. regulators could argue that deposit oversight rested with Antiguan authorities. Antiguan regulators faced capacity and scale limitations relative to the size of the capital pool being reported. Cross-border enforcement requires coordination. Coordination requires clarity. The structure was designed to blur clarity. Geography became compliance friction. The physical headquarters in Antigua projected institutional legitimacy. Offices, staff, infrastructure, all visible indicators of a functioning bank. Investors often conflate physical presence with financial solidity. The Caribbean setting also reinforced exclusivity. International banking evokes images of global capital mobility, diversified asset access, and private wealth sophistication. That narrative shielded the institution from domestic scrutiny heuristics. The offshore environment also reduced routine oversight intensity. Large U.S. banks face continuous examination cycles, stress testing frameworks, and capital adequacy reporting requirements under consolidated supervision. Stanford International Bank did not operate under equivalent systemic scrutiny from U.S. banking regulators because it was not a U.S.-chartered depository institution. This separation allowed the marketing arm to function domestically while the balance sheet remained offshore. Another critical layer was political proximity. R. Allen Stanford cultivated relationships within Antigua. Sponsorship of national projects, including high-profile sporting investments, increased perceived legitimacy and local institutional alignment. Economic contribution to a small jurisdiction can create implicit protective incentives. When a financial institution becomes intertwined with local economic identity, regulatory aggressiveness can diminish. Reputation laundering through visibility is a known defensive strategy. Stadium naming rights, philanthropy, and government engagement generate symbolic capital. Symbolic capital often precedes investigative hesitancy. The offshore shield also complicated asset tracing. If assets are held domestically with transparent custodians, regulators can issue direct subpoenas and confirm balances. When assets are allegedly diversified across international markets under opaque custodial arrangements, tracing becomes slower and more technical. Delay is strategic capital in fraud systems. Each month of delay allows additional capital aggregation. Each quarter of regulatory hesitation deepens investor entanglement. The structure exploited a structural weakness in global financial governance. No single regulator had full-spectrum authority over the entire enterprise. The U.S. Securities and Exchange Commission could investigate securities-related misconduct. Banking regulators focused on domestic depositories. Antiguan regulators oversaw the offshore bank charter. The enterprise spanned these boundaries without being fully contained by any one of them. Fragmented oversight produces oversight gaps. Investors rarely map these jurisdictional layers. They assume that if an institution operates visibly in the United States and maintains offices abroad, it must be comprehensively supervised. That assumption was never validated. The offshore positioning also influenced psychological risk assessment. Domestic fraud feels closer. Offshore complexity feels sophisticated. Investors often equate cross-border operations with institutional scale rather than regulatory vulnerability. The shield extended beyond regulation into litigation complexity. Cross-border asset recovery requires international cooperation treaties, local court proceedings, and diplomatic coordination. That complexity can discourage early aggressive enforcement unless evidence is overwhelming. From a structural standpoint, the offshore strategy achieved three objectives. First, regulatory diffusion. Second, reputational insulation. Third, enforcement delay. The institution did not need absolute immunity. It required sufficient time. Time allowed capital pools to expand. Time allowed investor trust to compound. Time allowed the narrative of stability to solidify. When early warnings surfaced, questions about oversight authority created procedural drag. Fraud systems often collapse not when suspicion emerges, but when liquidity stress coincides with enforcement clarity. The offshore shield delayed clarity. It also created investigative opacity around asset location. If reported assets were diversified internationally, confirming their existence required cooperation from multiple counterparties. Without independent custodial transparency, regulators were forced to reconstruct asset trails retroactively. Geography does not create fraud. It can, however, increase fraud half-life. The decision to situate the core banking entity offshore was not cosmetic. It was structural engineering. It altered the enforcement timeline, the verification burden, and the psychological comfort of investors. The shield was not impenetrable, but it was sufficient to sustain the illusion until external pressure and liquidity stress aligned. Offshore architecture does not prevent collapse. It postpones it. Chapter 4. The Authority Engine. The system required more than structure. It required belief. At the center stood R. Allen Stanford. Fraud at scale often concentrates around a single credibility node. In this case, that node was personal authority engineered to resemble institutional inevitability. Stanford did not present as a promoter. He presented as a banker. Tailored suits, controlled cadence, institutional vocabulary, global posture. The image was curated to signal permanence rather than speculation. Investors were not buying a product alone. They were buying proximity to a financial statesman. Authority reduces friction. When a central figure projects confidence backed by visible infrastructure, corporate offices, private aviation, global sponsorships, counterparty skepticism declines. Investors outsource due diligence to perceived stature. The authority engine operated on 3 reinforcing layers. First, wealth signaling. Private jets, luxury residences, elite social positioning. These assets functioned as visual proof of success. In capital markets, psychology, visible wealth is often interpreted as validation of competence. Second, institutional mimicry. Stanford Financial Group was structured to resemble a diversified financial services enterprise. Broker-dealers, advisory units, banking subsidiaries. Organizational complexity implied operational legitimacy. Third, exclusivity distribution. The CDs were not mass-market retail instruments. They were introduced through advisors, private channels, and referral networks. Scarcity increased perceived value. Restricted access creates prestige. The psychological loop formed quickly. Authority signals competence. Competence signals safety. Safety reduces scrutiny. Stanford leveraged this loop deliberately. Public appearances reinforced the persona. Interviews projected discipline. Messaging emphasized prudence, global diversification, and long-term capital preservation. The rhetoric mirrored conservative banking doctrine. Internally, decision authority remained centralized. In legitimate large-scale financial institutions, governance disperses power across risk committees, audit divisions, independent boards, and external oversight. At Stanford, authority was vertically aligned. Strategic decisions, reporting narratives, and capital allocation representations converged upward. Centralized authority increases narrative consistency. It also increases systemic risk. Employees operate within hierarchical systems. When leadership embodies certainty and confidence, dissent decreases. Internal challenge requires institutional culture that encourages it. Fraud systems rarely cultivate that culture. The authority engine extended beyond internal operations to investor perception. Many investors did not independently verify asset custody because they believed in the individual at the helm. Charismatic authority substitutes for documentary proof. This substitution is a recurring pattern in high-profile financial collapses. Consider the reputational leverage of Bernie Madoff. Institutional standing masked structural anomalies for years. Authority compresses skepticism timelines. When performance reports align with expectations and leadership appears stable, investors normalize anomalies rather than interrogate them. Stanford's cultivated persona also intersected with geopolitical signaling. Honorary titles, international recognition, and philanthropic engagements reinforced the perception of cross-border legitimacy. Symbolic elevation creates psychological insulation. Investors rarely suspect criminality from individuals positioned within elite networks. The authority engine also influenced advisor behavior. Financial intermediaries placing Stanford CDs often relied on corporate materials, historical performance summaries, and leadership credibility. The perceived stability of the organization reduced incentive to conduct adversarial verification. Commission structures layered economic motivation onto psychological trust. Within the organization, authority concentration can suppress internal alarm signals. When reporting flows upward and public messaging flows downward, contradiction becomes culturally costly. Fraud does not require universal complicity. It requires silence at critical points. The authority engine ensured that silence. External skepticism did emerge periodically. Questions about asset transparency and performance consistency surfaced. Yet authority can delay response. Institutions and regulators are often slower to challenge individuals who appear embedded within respected financial ecosystems. Confidence is contagious. So is deference. The operational risk of centralized authority is not merely moral hazard, it is systemic fragility. When confidence in the central figure erodes, the entire structure destabilizes simultaneously. There is no distributed resilience. In Stanford's case, the illusion of Caribbean certainty, the CD fabrication architecture, and the offshore shield all depended on belief in leadership continuity. Once external enforcement actions signaled that belief was misplaced, capital confidence collapsed rapidly. The authority engine had sustained the structure. It also amplified the collapse. Fraud at scale requires more than misreporting. It requires a credibility core strong enough to suppress scrutiny. Stanford built that core meticulously. The institution projected stability. The leader projected inevitability. Together they formed a system where personality replaced proof, until proof became unavoidable. Chapter 5. Regulatory latency and the oversight gap. Large financial frauds rarely survive because regulators are absent. They survive because regulators are fragmented. Stanford International Bank operated in a structure where oversight responsibility was distributed across jurisdictions. That distribution created delay. Delay created durability. The U.S.-based brokerage and advisory arms fell under the supervision of the U.S. Securities and Exchange Commission. The offshore banking entity was chartered in Antigua and therefore supervised locally. The deposit product, the CDs, was issued by the offshore bank, not a U.S. depository institution. This distinction mattered. The SEC regulates securities offerings and broker-dealers. It does not function as a consolidated global banking supervisor. Banking regulators oversee domestic depositories. Stanford's core deposit engine existed outside that domestic framework. The result was an oversight gap. Early red flags emerged. Questions surfaced regarding the improbably consistent returns, opaque asset allocation disclosures, and lack of independent custodial verification. Analysts and journalists raised concerns. Internal examinations began. But jurisdictional complexity slowed escalation. When regulators encounter cross-border entities, investigative authority becomes procedural. Requests for documentation require formal channels. Cooperation depends on reciprocal agreements. Each procedural layer consumes time. Fraud systems use time as oxygen. Investigations often begin with limited scope, document reviews, interviews, preliminary findings. Without immediate evidence of asset absence, enforcement actions can stall. Financial institutions are afforded procedural fairness. That fairness extends timelines. Stanford's structure ensured that confirming asset existence required international coordination. If the reported portfolio of global assets truly existed, custodians should have been able to confirm balances independently. Yet the absence of transparent third-party custodianship meant regulators had to reconstruct asset trails from internal representations. Internal representations are not evidence. Regulatory latency operates on several levels. First, informational latency. Data is incomplete or controlled by the subject entity. Second, jurisdictional latency. Authority is split across agencies or countries. Third, decisional latency. Escalating enforcement actions carries reputational and economic consequences. Regulators proceed cautiously. In Stanford's case, these forms of latency converged. The offshore banking charter placed the deposit base outside U.S. banking examination cycles. The domestic brokerage arm provided marketing access without consolidating asset supervision. The absence of independent custodial transparency complicated verification. Regulators face structural constraints. They cannot shut down institutions based solely on statistical anomalies. They require evidence, material misstatements, asset misappropriation, demonstrable deception. Fabricated reporting that appears coherent can delay that evidentiary threshold. The broader financial environment also influenced timing. During periods of systemic stress, such as the 2008 financial crisis, regulatory attention disperses across multiple high-risk institutions. Enforcement bandwidth narrows. Complex global fraud can hide inside macroeconomic noise. Another factor is reputational inertia. Institutions operating for years without public scandal accumulate presumed legitimacy. Regulators must balance enforcement action against the risk of destabilizing what appears to be a functioning financial institution. This balance can slow decisive intervention. Stanford benefited from this inertia. The bank had operated for years. It maintained physical offices, employees, documentation, and a visible operational footprint. There was no immediate collapse event forcing urgent response. Fraud detection often accelerates when liquidity stress exposes asset gaps. Until that inflection point, regulatory processes advance incrementally. Oversight fragmentation also creates diffusion of accountability. If a product is marketed in the United States but issued offshore, regulators may debate whether the primary violation is securities fraud, banking fraud, or cross-border misrepresentation. Classification debates consume time. Meanwhile, capital remains inside the system. The SEC ultimately acted, filing charges against Stanford Financial Group and related entities in 2009. By then, billions in investor capital had flowed through the structure. Regulatory latency does not imply regulatory indifference. It reflects structural complexity. Global finance evolved faster than consolidated oversight mechanisms. Institutions operating across borders can exploit that gap by segmenting activities across regulatory domains. The Stanford case illustrates a broader systemic vulnerability. When asset custody, deposit issuance, and marketing occur in different jurisdictions without unified supervision, enforcement becomes reactive rather than preventive. Reactive enforcement reduces recovery rates. By the time decisive action occurs, capital has often been redistributed, dissipated, or concealed. Regulatory systems function best when transparency is mandatory and verifiable. Stanford's architecture minimized verifiable transparency while maintaining formal compliance appearance. The oversight gap was not invisible. It was procedural. Procedural gaps are rarely dramatic. They are slow. And slowness is precisely what large-scale fraud requires. Chapter 6. Liquidity Illusion and the Mathematics of Collapse. Fraud can survive reputational questions. It cannot survive synchronized liquidity demand. At the core of Stanford International Bank was a simple dependency: continued capital inflow. The certificates of deposit were structured with defined maturities and interest obligations. Investors expected principal return at term completion, plus accrued yield. As long as redemption requests were staggered and new subscriptions replaced exiting capital, the system appeared solvent. This is the liquidity illusion. If a bank truly holds diversified income-producing assets, redemptions are met through asset cash flow or liquidation. Market volatility may affect pricing, but asset existence is not in question. If asset reporting is fabricated or materially overstated, liquidity does not originate from portfolio cash flow. It originates from new deposits. The illusion persists while inflows exceed outflows. Stanford's reported portfolio claimed global diversification across fixed income, equities, and alternative strategies. A real portfolio of that nature would reflect market conditions: drawdowns during credit stress, valuation shifts during rate volatility. Yet reported returns remained smooth. Smooth returns suppress panic. Panic drives redemptions. Suppressing redemptions extends scheme duration. The mathematics of collapse are mechanical. Assume a deposit base of several $billion. Interest obligations compound annually. Even modest yields create substantial payout commitments. If asset earnings do not exist at the scale reported, those payouts must be financed through incoming capital. Redemption velocity becomes the critical variable. When confidence is high, redemption velocity remains low. Investors roll over maturing CDs. Some reinvest interest. Advisors continue placements. The capital pool stabilizes. When confidence declines, redemption velocity accelerates. The 2008 global financial crisis introduced systemic stress into nearly every asset class. Investors worldwide reassessed counterparty risk. Liquidity preference increased. Institutions faced scrutiny. In such an environment, even structurally sound banks experience deposit pressure. For a fabricated portfolio, stress is lethal. If significant numbers of CD holders request redemption simultaneously, and if new capital inflow slows due to market fear, the liquidity gap becomes visible. A fabricated balance sheet cannot liquidate non-existent assets. At that moment, operational improvisation begins. Payment delays, administrative explanations, temporary freezes. These are precursors to exposure. The liquidity illusion also masked concentration risk. If the asset portfolio had been real, diversification would have mitigated shocks. In a fabricated system, diversification is narrative, not structural. Liquidity depends on a single factor: confidence-driven inflow. Confidence is nonlinear. It builds gradually and collapses abruptly. When regulatory action intensified in 2009 and the U.S. Securities and Exchange Commission moved decisively against Stanford-affiliated entities, confidence collapsed in days. Investors who had treated the CDs as conservative deposits suddenly faced uncertainty about principal existence. Redemption pressure surged precisely when the system could least absorb it. This is the terminal phase of Ponzi-like structures. The illusion of solvency is replaced by immediate demand for proof. Proof requires assets. If assets are missing or materially insufficient, collapse accelerates. Liquidity mathematics are unforgiving. Even a partially fabricated portfolio can fail if the discrepancy between reported and real assets exceeds available inflow capacity. Once redemption requests exceed available liquid capital, insolvency becomes operationally undeniable. The system then transitions from concealment to containment. Assets are frozen. Accounts are locked. Investigations formalize. Investors become claimants rather than clients. The broader lesson is structural. Fraud does not collapse because of moral awakening. It collapses because of liquidity imbalance. Stanford's architecture, offshore shield, centralized authority, controlled reporting, extended the illusion. It could not override arithmetic. In finance, perception sustains systems. Cash flow validates them. When perception fractures and cash flow reverses, even the most carefully engineered facade dissolves. The liquidity illusion did not fail slowly. It failed at the speed of withdrawal. Chapter 7. Enforcement Shock and Asset Freezing. Fraud structures rarely disintegrate organically. They are interrupted. In February 2009, the enforcement phase began decisively when the U.S. Securities and Exchange Commission filed civil charges against Stanford Financial Group and its leadership, including R. Allen Stanford. The allegation: billions of dollars in fraudulent CD sales backed by misrepresented asset holdings. The action triggered immediate asset freezes. Asset freezing is a containment tool. Its objective is preservation, not punishment. When regulators suspect large-scale misappropriation or fabrication, freezing prevents further dissipation of capital, while courts evaluate claims. For investors, freezing feels indistinguishable from collapse. Accounts once presented as stable deposits became inaccessible. Redemptions halted. Maturing CDs could not be honored. Liquidity, already strained, disappeared completely. This marked the transition from illusion to legal reality. Enforcement shock has systemic consequences. Confidence collapses instantly. Counterparties sever relationships. Advisors distance themselves. Political insulation evaporates. The offshore shield no longer functions once formal charges are filed in a primary capital market jurisdiction. Investigators moved to reconstruct asset trails. The central question shifted from, are returns consistent, to, do the assets exist? Forensic accounting efforts revealed that the reported diversified global portfolio was largely fictitious or materially overstated. Funds had been recycled, misallocated, or never invested as represented. The narrative of conservative international asset management unraveled under evidentiary scrutiny. Receivers were appointed to marshal remaining assets and assess recoverable value. In large-scale financial collapses, recovery is rarely symmetrical with loss. Asset tracing is complex, especially when cross-border entities are involved. Investors who believed they owned fixed-term deposits backed by diversified securities now faced protracted legal proceedings. Enforcement also exposed the governance vacuum. Independent custodianship had not protected assets. Third-party audit verification at institutional scale had not occurred in a manner consistent with reported holdings. Oversight fragmentation had delayed intervention, but could not prevent exposure once triggered. The case transitioned from regulatory action to criminal prosecution. In 2012, Stanford was convicted on multiple fraud-related charges and sentenced to a lengthy federal prison term. The authority engine that once projected inevitability now symbolized deception. But enforcement outcomes, while punitive, do not reverse liquidity mathematics. By the time charges were filed, billions had already moved through the system. Recovery processes depend on identifying residual assets, unwinding transactions, and pursuing clawback actions where legally viable. Recovery rates in Ponzi-like collapses are often partial. The broader institutional impact extended beyond direct investors. Advisory firms that distributed the CDs faced reputational damage. Financial intermediaries confronted litigation exposure. Regulators examined internal oversight processes. The case became a reference point in discussions of offshore banking supervision. Enforcement shock serves two purposes: containment and deterrence. Containment limits further harm. Deterrence signals systemic intolerance for misrepresentation. Yet, deterrence effectiveness depends on detection speed. In Stanford's case, the structure persisted for years before decisive interruption. This delay amplified losses. Once enforcement crystallized, the facade disintegrated quickly. The Caribbean certainty narrative ended not with gradual asset erosion, but with immediate legal confrontation. What had been marketed as a conservative deposit product became legally classified as part of a fraudulent scheme. The transformation was abrupt. Financial institutions can project stability for extended periods. They cannot withstand forensic audit once reporting control is removed. Chapter 7 marks the structural endpoint of the operating system. From this point forward, the story is no longer about architecture. It is about consequences. Chapter 8, Stanford versus Madoff. Two models of financial illusion. Large-scale fraud rarely repeats identically. It evolves. The Stanford structure invites comparison with Bernie Madoff. Both cases involved billions in fabricated performance. Both relied on steady, implausibly consistent returns. Both collapsed under liquidity stress. Yet, the operational architectures differed in important ways. Madoff operated primarily through an investment advisory structure, presenting a split-strike conversion option strategy that purported to hedge downside risk while generating stable yield. The core deception revolved around fictitious trade confirmations and fabricated account statements. Stanford wrapped his deception inside a banking instrument. Madoff sold strategy, Stanford sold deposits. That distinction altered investor psychology. Investment funds are expected to fluctuate. CDs are culturally associated with safety. By embedding fabrication inside a banking product, Stanford lowered skepticism thresholds even further than Madoff. The second difference was geography. Madoff operated domestically within the United States. His authority engine relied on industry prestige, regulatory board participation, and long-standing Wall Street credibility. Stanford leveraged offshore jurisdictional complexity through Stanford International Bank. The Caribbean Shield created additional enforcement latency. Madoff's illusion was reputational. Stanford's was jurisdictional and reputational. Both exploited statistical smoothing. Madoff's reported returns displayed unnatural consistency relative to market volatility. Stanford's CDs showed stability despite claimed exposure to global markets. In both cases, the absence of drawdowns was the hidden anomaly. Sophisticated investors later identified volatility suppression as a primary red flag. Another distinction lies in distribution channels. Madoff cultivated feeder funds, external investment vehicles that funneled capital into his operation. These intermediaries expanded scale while diffusing responsibility. Stanford relied heavily on financial advisors and private banking-style distribution networks, particularly in the southern United States and Latin America. The CD structure made the product easier to explain to conservative investors. Feeder funds signal complexity. Certificates of deposit signal familiarity. The liquidity trigger in both cases followed similar mathematical patterns. When market stress intensified in 2008, redemption pressure increased across asset classes. Madoff's structure could not satisfy withdrawal demand once inflows slowed. Stanford's system faced similar stress once enforcement actions and market panic converged. Liquidity collapse exposed asset absence. However, the perception of victim profiles differed. Madoff's investors often included institutions, charities, and wealthy individuals with access to alternative investment networks. Stanford's CDs were frequently sold to retirees and conservative savers who believed they were purchasing deposit instruments. The psychological breach felt different. Investment loss implies risk. Deposit loss implies betrayal of safety. From a systems perspective, both cases reveal recurring structural vulnerabilities: centralized reporting control, absence of independent custodial verification, over-reliance on authority signals, regulatory fragmentation or latency. The packaging changed, the core weakness did not. Both cases also demonstrate that fraud longevity correlates with narrative discipline. Neither operator promised implausible triple-digit returns. Performance was calibrated to remain believable. Moderation extended lifespan. The contrast between domestic brokerage fraud and offshore deposit fabrication underscores a broader lesson. Instrument labeling shapes scrutiny intensity. An options strategy invites analysis of trade confirmations. ACD invites trust in banking stability. Stanford exploited the latter. Comparative analysis is not historical curiosity, it is defensive intelligence. Modern fraud structures may blend elements of both models, using digital platforms, offshore custody, algorithmic strategy narratives, or AI-enhanced reporting fabrication. The form evolves, the vulnerabilities remain constant. Centralized control without independent verification is the recurring fault line. Stanford and Madoff represent different architectures of the same structural failure. Belief substituting for proof. One relied primarily on Wall Street credibility. The other combined banking symbolism with offshore opacity. Both collapsed when liquidity and scrutiny aligned. The next evolution of fraud will likely preserve these foundational mechanics while modernizing the wrapper. Understanding the differences clarifies the defense. Understanding the similarities reveals the pattern. Chapter 9. Operational red flags and defensive protocols. Fraud prevention is not theoretical, it is procedural. The Stanford case demonstrates that institutional aesthetics, offshore charters, and conservative instrument labeling can coexist with fabricated asset structures. The defensive response must therefore focus on verification architecture, not branding signals. Begin with custodial independence. If a financial institution claims diversified global holdings backing deposit instruments, those holdings must be verifiable through an independent third-party custodian. Asset managers should not control both allocation decisions and custody confirmation. Verification must bypass the reporting entity. Request direct confirmation from the custodian. If confirmation cannot be independently obtained, exposure risk increases materially. Second, analyze volatility fingerprints. A portfolio exposed to global equities, fixed income, and alternative strategies will exhibit statistical variance. Even conservative strategies fluctuate. Smooth return streams across market cycles require explanation supported by audited, position-level transparency. Stability without drawdowns demands forensic review. Third, interrogate jurisdictional structure. Cross-border operations are not inherently fraudulent. However, fragmented regulatory supervision increases complexity. Investors and advisors must map supervisory authority explicitly. Which regulator supervises deposit taking? Which regulator oversees securities marketing? Is there consolidated supervision across entities? If no single authority can articulate full-spectrum oversight, systemic risk increases. Fourth, evaluate audit integrity. Independent audits are only meaningful if the auditing firm has institutional scale, reputational exposure, and verification authority. Confirm that the auditor directly validates asset existence through custodial reconciliation rather than relying on internal representations. Audit scope matters. Fifth, assess redemption mechanics under stress. Inquire how liquidity is generated if redemption requests accelerate. Does the institution maintain liquid reserves? Are assets tradable and custodied independently? What percentage of the portfolio is illiquid? Liquidity modeling is a defensive tool. If redemption funding relies implicitly on continued deposit inflow, the structure resembles capital recycling rather than asset-backed solvency. Sixth, scrutinize yield calibration. Above-market returns can be legitimate if supported by identifiable risk exposure. However, consistent outperformance without volatility alignment to market benchmarks requires explanation supported by transparent position data. Moderate excess yield is more dangerous than extreme promises because it bypasses skepticism thresholds. Seventh, examine governance dispersion. Centralized authority with minimal independent oversight elevates operational risk. Legitimate institutions disperse power across risk committees, independent directors, compliance officers, and external advisors. Authority concentration correlates with narrative control. Eighth, test transparency response speed. When detailed documentation is requested, how quickly and comprehensively does the institution respond? Delay, redirection, or reliance on summary documents instead of primary source confirmation are early warning indicators. Defensive protocol requires layered verification. Branding is irrelevant. Geography is secondary. Documentation is insufficient without independent corroboration. The Stanford structure leveraged trust in the certificate of deposit wrapper issued by Stanford International Bank. Investors assumed deposit safety because the instrument carried familiar labeling. Defense begins by decoupling familiarity from safety. Operational defense checklist: confirm third-party custodial reconciliation, validate audit scope and independence, map regulatory oversight boundaries, analyze statistical volatility relative to stated strategy, stress test liquidity under redemption pressure, evaluate governance structure for authority concentration. Fraud systems exploit psychological shortcuts. Defensive systems eliminate shortcuts. The final insight is structural. Fraud does not require investor ignorance. It requires investor assumption. Assumption that custody equals asset existence. Assumption that offshore equals sophistication. Assumption that conservative instruments equal low risk. Each assumption must be replaced with documented verification. The Stanford case is not merely historical collapse. It is a blueprint of how institutional symbolism can override procedural diligence. Defense, therefore, must be architectural, not emotional. Verification is the only antidote to engineered certainty. Chapter 10. The Pyramid Archetype in a Yield-Starved World. Fraud does not emerge in isolation. It emerges in environment. The Stanford structure thrived during a period defined by yield compression and capital anxiety. When traditional banking instruments underperform, investors search for alternatives that promise stability without volatility. That demand creates structural opportunity. The certificate of deposit wrapper issued by Stanford International Bank exploited a fundamental market tension: the desire for safety combined with dissatisfaction over low returns. In yield-starved environments, risk tolerance increases subtly. Investors do not perceive themselves as taking risk. They perceive themselves as optimizing. The pyramid archetype adapts to this psychology. Classic Ponzi schemes promise extraordinary returns. Modern variants promise slightly better returns with extraordinary consistency. The calibration has evolved. The core structure remains constant. Capital inflow finances reported performance. Reporting is internally controlled. Verification is structurally weak or fragmented. Authority substitutes for transparency. Stanford did not present as a speculative growth vehicle. It presented as a conservative banking alternative. That distinction allowed the pyramid structure to embed itself within retirement accounts, conservative mandates, and capital preservation strategies. The archetype scales when three conditions align: yield dissatisfaction, regulatory fragmentation, trust concentration. Yield dissatisfaction lowers skepticism. Regulatory fragmentation slows enforcement. Trust concentration reduces independent verification. In the digital era, this archetype can evolve further. Offshore opacity can be replaced with algorithmic opacity. Instead of claiming global bond allocations, future structures may claim proprietary AI trading models. Instead of physical Caribbean offices, platforms may operate through distributed digital interfaces. The wrapper changes, the mechanics persist. Capital recycling remains the hidden engine. A fabricated portfolio must always answer one question: where does liquidity originate? If liquidity depends primarily on new participant capital, the structure is pyramidal regardless of branding. Modern frauds may incorporate cryptocurrency custody, decentralized finance terminology, or synthetic asset claims. Yet, if independent third-party verification of assets and transactions is absent, the vulnerability mirrors the Stanford model. Another evolution vector is private market opacity. Private equity funds, venture structures, and alternative credit vehicles often rely on internal valuation models. Without robust independent auditing and custodial transparency, valuation smoothing can mask performance reality. The Stanford case illustrates how modest yield enhancement, wrapped in conservative language, can disarm experienced investors. The pyramid archetype does not require greed. It requires comfort. Comfort in branding, comfort in authority, comfort in stability. Fraud architects study this comfort carefully. They avoid implausibility. They avoid spectacle. They operate inside the psychological boundaries of reasonableness. That is why defensive intelligence must be structural rather than reactive. Ask always: is asset existence independently verified? Is custody separated from management? Is volatility consistent with exposure claims? Is redemption liquidity demonstrably supported by real assets? If any of these answers depend on trust alone, structural risk exists. The broader lesson extends beyond one institution or one individual, such as R. Allen Stanford. The lesson is systemic. Capital markets reward innovation. Fraud innovates as well. Stanford industrialized the deposit illusion. Others may industrialize digital custody illusion, algorithmic trading illusion, or ESG performance illusion. The pyramid archetype adapts to prevailing narratives. In a world of compressed yields and complex global finance, certainty is valuable. That value can be monetized legitimately or fabricated. The difference is verification. Stanford's structure collapsed under liquidity stress and forensic scrutiny. Future structures may collapse under cyber audit, blockchain traceability, or AI-driven anomaly detection. But collapse will always trace back to the same origin: performance claims unsupported by independently verifiable assets. The archetype survives because human psychology remains constant. Defense survives only if verification remains uncompromising. That is the enduring lesson of offshore banking and CD fabrication. Not that fraud exists, but that certainty, when engineered, is often the first warning sign